about Meta. Brad Gerstner was on last week. We've had an ongoing discussion about big tech, entitlement, spending, the number of employees at these companies. On Monday, Brad, I think, got a little worked up on the last pod maybe and dropped an open letter. Some might say activist. He would say constructivist to Zuckerberg and the team over there. Hey, maybe pump the brakes on the CapEx, maybe do a RIF, maybe become profitable. Anyway, the revenue and the third quarter was a complete, utter disaster for Meta, and the stock has plummeted and been under $100 a share. I don't know who wants to start on this one, but
okay, look, there's a lot to unpack here, so I think we should take our time, because I think one part of it is Meta,
okay,
but one part of it is actually about what we talked about a few episodes ago, which is like this big tech put, right? Mm-hmm. Where they define the rules of the game on the field for every other startup. Mm-hmm. And I think the third part is just about like the era of big tech being over and what it means for the stock market. If you section it out in those three ways, Jason, we can have a pretty rich convo. I'd love to tee some of this up.
Where do you want to start?
Okay, so let's start with Meta. So Nick, can you please throw up Apple versus Meta for a second? And let me just give you guys the talk track, and then maybe we can go from there. So when you look at Apple versus Meta, there's this really interesting thing that comes up, which is in 2016, and we've said this before, you could not give Apple stock away. They were generating a ton of cash. It was sitting on the balance sheet. In many ways, Facebook was doing the same thing. And there was this famous dinner. I don't know if it was a dinner that ever happened, but that's how the lore is told, between Tim Cook, Carl Icahn, and I think Luca Maestri, the CFO. And in it, what Carl Icahn said is, listen, I have a below-the-line suggestion for Apple. And what does that mean? If you look at a P&L, you have your revenues, that's above the line. Mm-hmm. You have costs, that's also above the line. And then you have your profits, and then it's what you do with the profits. So what he was suggesting is below the line. After the fact, he had no suggestions for how the business should be run. He just said, give us back the money and we will reward you. The stock price will go up. And what's interesting to note here is the black line is the performance of Apple stock as they've given back, and they've used a ton of their own balance sheet cash to buy back the stock. Okay, so they've spent $396 billion since 2016 to buy back stock. In the same time, Facebook has spent almost $100 billion. Now, here's where you start to see the divergence. So you would have said, well, shouldn't Facebook's stock have reacted in the same way? And for a very long time, it actually looked like it was, right until about September 21. And then obviously this thing fell off a cliff. And the reason why it started to fall off a cliff was somebody started to notice that, hold on a second, even though you're buying back all these shares, the bottom of the funnel, right? You're leaking all of these shares to all of these new employees. Why are you hiring so many people? And this is when people started to uncover what was happening above the line at Facebook and is what caused this massive dispersion. So, Nick, if you go to the first chart, so what has actually been going on above the line? Here's what's going on. If you look at the light purple bar, Facebook in the last 2 years have spent $25 billion on reality labs. And they said that they're going to spend, meaningfully more in 2023 and then sustain that investment for a while. So if you do a little bit of math, if they spend around $4 billion a quarter right now, so $16 billion a year, that'll go to $25 billion in 2023, and then they'll sustain that. What that means is that over this, 12 or 13 year life of reality labs as we've seen it, these guys will have spent $250 billion. And what I did here was I just wanted to understand.
Hilarious.
I wanted to understand $250 billion in the context of other major leaps in humanity. So at the left is what Apple spent in its entirety. By the way, these are all inflation adjusted dollars for today. Apple spent $3.6 billion to create the first iPhone. And what they did was they said every subsequent version of the iPhone would only be funded from the cash flow and profits of the generation before it, right? So they used consumer demand as their guiding principle. So it was a very incremental approach. iPhone 1, iPhone 2, and now we're at iPhone, 14 or whatever, 13. But the point is, it took $3.6 billion to get that juggernaut off the ground. The Manhattan Project will cost $23 billion in today's dollars to create the atomic bomb. Tesla, in its entire life, spent $25 billion to get to free cash flow profitability, and they took this incremental approach as well. We'll create the coupe, the Roadster, then the Model S, then the Model X. They iterated their way. They used customer demand and all of that revenue to fund future growth. The cum spend on Tesla was $25 billion. Boeing spent $32. Google and other bets has spent $40. The only thing that I could find in history that is comparable to what Meta has basically said they're going to spend is the entire Apollo program, which cost in today's dollars $250 billion as well. So the problem is that below the line, Meta was doing the right things. Above the line, they've created, I think, an enormous set of pressures for themselves, which is, if you think about the Apollo program, this was 13 years of building rockets, getting to low Earth orbit, then getting to be able to, orbit the Earth, then eventually building an entire infrastructure and capability to land on the moon and get back. So there was a lot of incremental progress there. I think what people don't understand is, where is this $250 billion going? And is it going to be a leap in humanity at the scale of the Apollo program? Because it now is becoming the single largest capital allocation program in capitalism history. Nothing comes close. So I think that is a really interesting, maybe jumping off point to talk about what's going on inside of this business. I think they're doing all the right things below the line, but there's this one major big red flag above the line that has to be probably better explained by them if they want to have long-term shareholders. And basically what happened was, when people heard this, they said, this is a dumpster fire. We're out of here.
Sachs, what do you...
Can I ask a question? What happened with the whole Brad Gerstner proposal? Was that actually discussed on the call? On their earnings call?
They
ignored.
Well, I don't want to say it was totally ignored, because I do think that they should be given credit for a couple of things. I think that the core business continues to march forward. And they basically said, look, we're going to slow headcount growth. Some teams will shrink. I think the problem is really in this Reality Labs. The amount of investment that they're making is so outsized and so abnormal and doesn't compare to anything anybody's ever seen. I think everything else in the business seems to be actually quite functional. So the problem is that this above the line thing, though, has become so big, it could sink the business. It's very, very hard to see an investment case for $250 billion of money in the door before you really start to see something magical. Now, they may have something super magical that nobody knows about, that they're going to unveil and say, ha, see, told you. And maybe there should be a set of outcomes where we plan for that. But the reality is, it's, $25 billion a year for the next umpteen years, and it's.
I thought the number was $10 billion. Where did the $25 billion come from?
No,
this number.
It's $4 billion a quarter right now, so $16 billion a year. And they said that they're going to significantly increase it to 2023. So I just assumed it was a 50% increase. Maybe significant means 100, but 16 goes to 25, and they said they're going to keep going at that pace. And so if you run that out till 2030, that's how you get to $250 billion.
You think there's a business here in VR, AR, Sachs? You think this will be the next platform? I guess that's a key question to ask here.
Yeah, I mean, I actually like these Oculus products. I think it's a very cool product. The question is really just about the magnitude of the investment level. But I think there is a future in VR and AR, and it is you've tried the Oculus headset before. It is like a very magical, experience with software. One of the most magical that I've had. The question is just, we're talking about magnitude and time frame.
And use case, I think, also comes to mind for me, Sachs. Like, everybody seems to, try and then say, oh my, and then say goodbye to these headsets. Like, people buy them, they try them, and they're like, this is incredible. But there's no use case for them. I see very few people who use them on a regular basis.
We just invested in a company that is creating professional flight simulators using VR as a component. And
so
these
education,
I think training is actually a huge use case.
Huge.
And by the way, these are not like video game flight simulator programs. These are they create physical cockpits with knobs and dials and stuff. It's just that the pilot is using a professional grade VR headset. And so they're able to load, a lot more training programs and scenarios, and they're able to train on more planes. They can like change up the cockpit. By the way, the cockpit's on gyros, so it actually moves around.
Let me put it, Jason, in a different way. I think that we should assume that VR and AR is going to be a really important part of our existence. And I do think that, as David said, many of these experiences are magical. I think what investors reacted to was spending $25 billion a year needs to be measurable somehow. And I think what they said is the things that we're seeing don't necessarily tell us that this bet is going to make any sense at that level of spend. So if you were spending $2 billion a year or $3 billion a year, I don't think people would have said anything. It's just the magnitude relative to the progress that's being demonstrated publicly. And that's the thing that I think the Tesla program got right, the Apple phone program got right, the Boeing program, even the Apollo 13 program for that quantum of spend. So it's not to say that you can't spend $250 billion over the next decade.
But you got to eat what you kill.
You have to be able to show progress in a way that says, this investment is tracking.
Freeberg.
I think the biggest issue he's having is he's trying to build a moonshot that you'll only get to see when I'm done. It's like, hey, I'm behind the curtain over here. I'm Willy Wonka. I'm going to come out with the most amazing chocolate bar in 10 years. And after I spend $100 billion. But don't worry, it's going to be awesome. Trust me, shareholders, it's going to be amazing. And with consumer products in particular.
Guys, you keep saying 100. It's 250.
Yeah, whatever it ends up being. In general, I think consumer products, you want to see them in the market and you want to iterate to success. Tell me one consumer product that launched and didn't iterate after launch and didn't kind of evolve over time in a way that responded to what the market was telling the builder or producer of that product.
But Freeberg, in fairness to them, they're doing that too. It's just, I think what people can't square is we see the next gen Oculuses and then we see the spend and we think that they're upside down relative to what we're seeing in terms of progress. I think that's what people are reacting to.
If he was spending $5 billion a year, this wouldn't be an issue, Chamath, right?
A nothing burger.
A nothing burger. People would say, good idea, throw a long ball.
I think that there's two kind of ways to think about the distinct things that they're building. One is this hardware platform with Oculus and a better kind of experience for immersive experiences, whether that's VR or AR. The second is what's all the software layer look like and what goes on in that platform. That's where this thing seems to be pretty short and where people seem to have a lack of confidence and conviction. The hardware seems super interesting, but I got to tell you, Epic Games just raised money earlier this year at a $31 billion valuation. If Zuck was a smart guy, he would go to Tencent and cut him a check and buy the whole thing for $50 billion and, buy those guys. Because that's a platform that has a couple 100 million active users, is making money, has a really deep, immersive, but two-dimensional experience. It's not 3D, it's not on VR.
Right.
And on top of Fortnite and on top of their engine that they've built, there are just countless experiences and worlds and interactions and models that exist today that are already active, that are being iterated, that have been evolving for years. And if you look at where Fortnite and some of the tools and experiences that have been built into Fortnite over the past couple of years sit relative to when Fortnite was first launched, I don't think that Tim Sweeney and that team would have ever said, hey, this is where we're going to be in a couple of years. This is what we're going to be doing. It was part of an evolutionary experience of building a great platform and having an engaged user base. And unfortunately, there doesn't seem to be a great engaged user base in the software layer of what he's built here today, making it very difficult to track a path, to get consumer feedback, and to identify where that goes over time. The hardware experience, totally understand that. That takes time to build something incredible. Also should be in the market and getting iterative feedback. But really, that software piece is what feels short.
To your point, I think that that's another great example of a below-the-line decision that they could have made with all of this money. If you compare what Brad asked Facebook to do on Monday versus what Icon asked Apple to do in 2016, Icon basically said, just make this below the line change and everybody will be happy. It's a do no harm solution. None of us are getting in the way. We're not telling you how to run the business. The thing that I think that, what Facebook had to react to was Brad's suggestions were fundamentally above the line. It's like, firing 20% of the people or 30% or changing the capital allocation would require some changes to strategy. And I think this is a good moment to recognize that as much clarity as Brad's letter had and as much sense as it probably makes to outsiders looking in, the minute you have to tell companies how to change above the line, it's just a good reminder to me that no, it's not going to happen because these folks will not want to make those changes. They don't. So
you're saying Zuck won't make the changes?
I think it's natural human psychology. I think you want to make those changes yourself. You don't want to be told what to do.
Got it. Sachs, what do you think this is going to do to governance in Silicon Valley writ large?
Probably nothing.
Really? So it's not going to change anything?
Well, it is interesting. If you look at Elon's Twitter deal, there is no dual class. Everybody there's this one class of security. This is one type of stock. So it's simple majority voting. Elon actually had the choice of doing dual class and he decided not to. So that's pretty interesting. So if people want to follow Elon's example, then they would, not necessarily go for dual class.
Tesla doesn't have super shares either. And he said it many times. If you want to vote me out, you can vote me out.
Right.
If you don't think I'm doing a good job. So
he's
SpaceX either.
Yeah, he's putting his neck on the line.
Is that right? And I don't know. As a SpaceX shareholder, I have no idea.
Well, I don't know SpaceX class structure. Yeah,
I can't remember.
SpaceX isn't public yet, so maybe it doesn't matter. Like they haven't reached that decision point.
Yeah.
I will tell you, I think Starlink has such a huge opportunity. I just got Starlink for 2 locations as a backup because, you lose your internet a couple times a year and you can get these routers now that'll fail over. So since I'm doing business, I can't really lose the internet. So for $1,000 a year, I can have Starlink as a backup. And I started using it and the speed is getting pretty compelling already. Like Zoom calls, you can't tell the difference right now most of the time. And certainly for web browsing or watching a movie, it just works. So I could see many companies putting in Starlink, even if they have a fiber line or whatever, just as a backup. That business alone could be ginormous.
Well, just to provide both sides of the story here. I mean, the reason why dual class emerged and was seen as viable is that if you look at the historic performance of internet companies, the ones that have done the best, performed the best, are the ones where the founder stays involved for a long time. And the ones where the founder checked out, like after a few years and hired a professional CEO, those are the ones that went off the rails. It happened again and again. So there is an argument for dual class in the sense that you keep the founder involved and you avoid a power struggle.
That's not what happened.
Well, but that was why it was considered acceptable.
Well, I think it was considered acceptable because in the Google bake-off, all these banks were clamoring so hard. And, there were 2 vectors of iteration. One vector was on the way that, Google wanted to do this IPO process. They picked Credit Suisse. They did this Dutch auction. The other one was the bankers basically pitched them on a dual class voting control structure. And
it was Morgan Stanley.
Morgan Stanley. And once Google got it, everybody else was able to copy because all the bankers realized that if you want to win a bake-off, you're not trying to win over the CFO. You're actually trying to win over the CEO. And giving that person control turned out to be an incredible commitment and a way to win the deal. And so I actually think it was never a governance issue or a reflection of how value was created. It was just basically a feature that one banker used in an IPO bake-off to try to differentiate versus another. This is why, like I said, Elon has never cared about that stuff because it's like, if I'm not doing well, vote me out, which is so clarifying because he realizes that that's actually the best check on him making bad decisions. And I think part of it is why he's done so well. One class of stock, he was able to negotiate an incredible compensation package, and he has clarity on the few things of the business that matter.
But I think he's also more compelling than some of these other guys. And there may be some degree of feeling like this is a mechanism that other people need, that Elon has a degree of confidence and a degree of charisma and salesmanship that gets him what he wants. I just want to read you guys the excerpt from Larry and Sergey's founder's letter from the IPO in 2004. As a private company, we've concentrated on the long term, and this has served us well. As a public company, we will do the same. In our opinion, outside pressures too often tempt companies to sacrifice long-term opportunities to meet quarterly market expectations. Sometimes this has caused opportunities to manipulate financial results in order to make their quarter. And they go on and on and on. And they say, look, you might ask us how long is long term. Usually we expect them in a couple of years. And they go on. Many companies are under pressure to keep their earnings in line with analyst forecasts. Therefore, they often accept smaller, predictable earnings rather than larger and less predictable returns. Sergey and I feel this is harmful, and we intend to steer in the opposite direction. I think that the statement that they made really resonated in Silicon Valley at the time, particularly during this era of what people were calling Web 2, and the internet was being rebuilt, and all these businesses were starting to thrive. And it was like, we have this massive road ahead of us, this long road ahead of us, and we can really change the world. But in order to do it well, in order to do it effectively, we have to, as entrepreneurs, as engineers, be able to have the freedom to operate for the long term.
I don't think it had anything
and not get stuck in the short term.
But
and
it
I
had,
think that
it had nothing to do with anything. There was no pressure on them. It's not like they shied away. It's not like that super voting control allowed them to make one seminal decision.
There were quarters, Chamath, where Google was getting a lot of heat for the amount of money they were spending on CapEx because they were building their own data centers. They were building their own servers. They were building their own, eventually, DRAM. They started to build their own switches. Every element of how Google built a competitive advantage over time was difficult for analysts to understand.
But you're not saying
investors to understand.
But you're not saying the obvious thing. The reason why they were allowed to do it in the end was because more and more users used their product because it was better and better. And they consistently meet and beat every expectation.
They literally didn't need to use this option.
This was not.
They didn't need to call this option.
This is not a company that went back and forth between meeting and missing expectations. Okay, they were up and to the right.
They were up and to the right is correct. That is the general principle. But the time to return, the ROIC, the time frame to hit their ROIC targets was long. And it was hard for people to get that when they bought YouTube.
True. That is not
YouTube.
David,
they bought YouTube and they spent tens of billions of dollars investing in YouTube before it generated cash.
I get it.
I think that would,
But what you're saying is not true. It is not mathematically true what you're saying. There was no 13-year ROIC play that they executed on. Not true. And you can just
I disagree.
They may have had challenging quarters.
They put their own fiber optic lines across the oceans. The capex at Google was often scrutinized and not well understood.
I get it.
You can read, but Chamath, you can read the analyst reports and see how difficult this was.
All I'm asking for you to do is look at
they had voting shares is what gave them the ability to do this.
Bullshit. I think that if you look at their performance, their EBITDA margins and their ROIC was exceptional when they were making those investments. In fact, I would say the opposite. I would say that they were surprised by how high quality their business model was. They were generating so much cash. What they were probably thinking back in the day was, oh my gosh, we need to make sure that we are actually making long-term investments. And now we have the ability to do it because we have all this cash we didn't expect. And we should probably bleed off cash so that we don't show 50% gross margins to raise all of the attention of regulators and everybody else.
And so what do you think Zuck is doing? What's different today?
I think that they have an incredible core business.
Because he's got good business, good EBITDA margins, good revenue growth. What's different?
They have an incredible core business, and they have decided, for whatever reason, to make an enormous bet. And that bet could be a very good bet. But the way that you make a bet, and you've said this well, is you have to look at incremental progress. And you have to demonstrate that all of these bets make sense, because the problem is when you get compared to the Tesla program, look, Tesla is reinventing an entire category, trillions of dollars of energy generation and transportation, but they did it in 1 year of Meta Reality Lab spend. Apple reinvented an entire compute platform on 1 quarter of Meta's Reality Lab spend. That's not a judgment. That's just a numerical observation. So if you want to get people on your side, you just have to be able to double click into that in an elegant, articulate way and say, here are all of these things that justify $25 billion a year.
Hey guys, let me show you a chart. Here's a chart of Alphabet's capital expenditures by quarter, and here is their revenue. The blue line, that's $7 billion right now.
This is my point.
Yeah.
They struggled. They struggled to find ways to spend money.
Exactly. I mean, literally, they created Project Loon. They were going to do balloons.
Guys, they wanted to build fiber. They wanted to build at one point a ladder to the moon. A ladder. They thought they could build.
Going from TED to the
It was an elevator,
Loon.
but yeah.
Whatever. An elevator is in that
You were
7
going to
point.
have to climb there, right?
The elevator was in the purple line.
Yeah.
And somewhere in there, they spent $1 billion or whatever on maps, and it ended up being a phenomenal asset when the whole world moved to mobile.
I think we're not saying the obvious thing.
We spent a lot less than billion.
We're not saying the obvious thing, which is great leaps of progress in humanity are not correlated to dollars all the time. In fact, most examples are the exact opposite, which is it's more about small and extremely nimble and talented management teams that generate human progress. And again, if you go back to that first chart of Apple versus Meta, the fact that you've hired so many people to work on a category with so much money, it just violates a lot of pattern recognition that people have historically seen. So all I'm saying is maybe this is a great bet. They just need to do a better job of explaining
this
it.
would have been so much easier if he had just put Sheryl Sandberg. I'm saying this could have been such a better transition. He should have put Sheryl Sandberg as CEO of the Facebook Corporation. He should have become CEO of Meta. And then he should have ran that other business to print even more profits. And then if you look at some of their forays into building a super app, they added Facebook Marketplace to Facebook, and it was a huge hit. They started to pull the e-commerce string over at Instagram. It started to work. There's just no focus on those products. If you look at the Facebook collection of billions of users, what apps could you add to that? Whether it's payments, they did the whole crypto thing, they gave up on that. It seems like there's no leadership on the Facebook side that actually wants to take swings over there. They just are obsessed with this one thing. It makes no sense to me.
I think that there's probably part of it, which is that, when you're working on a thing for a long time, there's a certain personality type that loves the mastery that comes from working on the thing for a long, long time.
Yep.
And then there's a different personality type that likes more shiny new things.
Yeah.
And you kind of have to have a balance of all of those different people. And so maybe what we're seeing as well is that, you're right. Maybe the boring business was just labeled too boring internally, and there wasn't enough heat around wanting to work on it forever.
Nobody wanted to keep grinding.
And so you wanted to throw these big Hail Marys. All I'm saying is you just need to explain the Hail Mary.
All right,
by the way, let me just ping you on this. So the Meta spend in the quarter relative to their revenue, it's about 15, or the virtual reality stuff, it's about 15%. Does that sound right?
I don't know, but they said it was $4 billion this quarter.
Yeah, so $4 billion out of 27 of revenue. So it's about 15%. And Alphabet's last quarter revenue was $70 billion, and they spent about $1 billion.
Let me show you this. I actually have this chart handy because I was talking about it on This Week in Startups.
Which is 1.4%. So on a relative basis, Alphabet is spending 1/10 of what Meta is per dollar earned, or top line revenue earned, on their other bets category. So Chamath, do you think it's a relative spend problem that because they're spending 10 times as much as a percent of revenue, that it's causing so much heartache, even if it is directionally correct?
If you want to see the CapEx versus revenue, here's that on the screen right now.
Yeah, no, we know what
we haven't shown. This is Google and Meta on the same chart. The blue line on the red on the bottom, $9 billion in CapEx for Facebook, $7 billion for Google.
Is this your new charting tool that you guys built?
Yeah, no. I've been doing it on This Week in Startups all the time. Yeah.
What do you use? What is this?
Yeah, actually beep it out because I don't want to give them a free sponsor.
Yeah.
I'm not giving them a free promo.
Oh, they didn't let you invest?
Whatever. I mean, they wanted to sponsor, man.
The truth comes out. They didn't let him invest.
Yeah. No, they've been around forever.
Oh, okay.
Anyway.
It's a good product. I've used it before.
Just a beep. It's a good product. Listen, if we're going to promo something, it's going to be call in or...
Nick, can you throw up the histogram for a second?
Supergut. This is Supergut charts.
So look,
this is the new charting feature on call-in.
I think the problem is, here's the problem. Let's just say that you're an analyst that works at a large hedge fund or a mutual fund. And you woke up on Wednesday and you had a decent day, and then you went into the earnings call believing that, there's a value play here and there's a lot of upside, which I think there is actually. This company can throw off an enormous amount of cash. But then what you hear is, okay, we're spending $4 billion a quarter. That's going to go up materially. And then we're going to keep 23 spending levels roughly the same to the future. So then you have to go back and build a model. You're going to be hard pressed to not get to this number. Maybe you don't get to 250. Maybe you get to 200. My point is, all of a sudden you have to go back into your, portfolio manager and say, they're going to spend all of this, after-tax cash flow on this stuff. Or sorry, not after-tax cash flow, but below the, above the line spending on this stuff, which won't come back to us as shareholders. and we're going to dilute the stock 2 or 3% a year. So that's another 20% dilution. And it just becomes what I've said this before, you move the stock into what's called the too hard bucket. From the it's obvious to, wow, that's really tough, and I'll just take a wait and see approach. I think yesterday there was a quarter billion shares that traded hands of Facebook, just a ginormous number. And so, I think it's...
You think that's tax loss harvesting too? Where at the end of the year, maybe some people want to take the loss?
So there's tax loss harvesting for individuals. By the way, there was a couple comments which we should talk about and explain what tax loss harvesting is. But a bunch of these mutual funds year ends are actually October 31st. So to your point, Jason, the stock basically gets decimated 25% in a day. The T Rows and the Fidelities are like, all right, book the tax loss and be done. And we'll relook at it next year, quote unquote, next year. So, if you put on the spread trade, so we talked about the spread trade, there was a big hedge fund manager that, November 6th, right, when we were basically calling the top of the market and told people to sell, one of the trades that he put on, Nick, if you want to just throw it up, was this long Google short Meta spread trade. He called to tell me that, he closed it out yesterday. This is how that trade did. So yeah, there was just a lot of folks that just kind of like went to the exits and said, you know what, we're kind of done for the short term. I just think that it's a moment in time where those folks have to realize that they just have to explain a little bit better how they want to spend the money and show a little bit more incremental progress that justifies that level of spend. Otherwise, people will be a little skeptical. They'll build their own histogram and it'll violate too many rules. And so it goes into the too hard bucket.